Welcome to today's video. In today's video, I'm going to be breaking down one of the most important confluences in day trading. Not only is it one of the most important confluences, it is one of the easiest confluences ever to learn and understand how to use. Trust me, it does not get any easier than this. But if you master this confluence right here and you learn fully how to use it, your trading will become so much better, you won't even believe it. This confluence right here allowed me to catch this beautiful trade that you can see on the screen right here. And I'm about to break it down and show you exactly how to use it. So lock in. So this confluence right here is called equilibrium, and it's as simple as this. When we are in an uptrend or when we are in a downtrend, we simply just can't continue forever, right? We have to get a retracement. We have to get a pullback, right? Now, how do we know where the market wants to pull back into? When do we know that the market has now pulled back into a good area and is now ready to continue with the trend? This is what equilibrium is all about. Now, let's have a look at this example right here. We can see that in this case, we have an uptrend. We are forming higher highs, higher lows, higher highs, higher lows, and we are clearly ranging higher. Now, what can the market not do forever? Well, it can't keep going up higher. It simply can't keep going higher and higher and higher. So what does it have to do? It has to retrace into a key level. Now, here is where equilibrium comes into play. When we mark out equilibrium, we mark it out from the swing low of the move to the swing high. And as you can see, it then creates this 0.5 region right here. This 0.5 region is a key region. Why? Anything below this, anything in this zone right here is what we call a discount. Anything above this zone right here is what we call a premium. Now, when do we want to look for buys? We don't want to look for buys when it's in a premium because it is not a good price. We want to look for buys when price has come to a discount. So what can we see in this example? We can see that price comes down into this discount. After coming into this discount, then we get that beautiful move. Why does this happen? Well, when you think about it, do the big banks, do the big institutions that are putting millions and millions and millions into their orders, do they want to buy up here? Do they want to buy when the price is that high? The answer is no. Would you buy at that price? No, you wouldn't, right? You'd wait for price to come into a key zone, which in this case for us is called equilibrium. We want it to come into this discount. We then wait for our model and bang, we can catch those beautiful buys to the upside. Now, this works the exact same for when we're looking for sells. We just simply mark out our swing high to the swing low, wait for price to come into the midpoint, equilibrium, and then we look for sells. It's the exact same concept. And trust me, I'm about to show you exactly how this works. Let's look at the NASDAQ on the hourly time frame. So what can we see, right? We can see that we clearly had a big sell-off and market structure is bearish. But can we just keep selling off forever? No. We can see that we had a big, strong, impulsive sell move right here. But then we started to get a bit of resistance. We start to chop about. Yes, we're still moving down, but not as strongly. Now, what does that tell me? Tells me price probably wants to pull back into equilibrium. Now, let's use our GAN box. We mark out equilibrium from the swing high down to the swing low, right? We've got swing high up here, swing high up here, we've got swing low down here. Now, what can we see? We can see that market comes down. We then retrace perfectly into equilibrium. And right from there, bang, we get this bearish rejection. Not only have we tapped into equilibrium, not only have we come into a discount, we have also tapped into a bearish hourly fair value gap. So even more reason for price to then sell off, right? The big banks, the big institutions, they don't want to sell down here. They want to sell when price is in a discount, right? And as you can see, we tap into it and then we get that beautiful rejection. So this is what I'm talking about. This is how we use equilibrium on the higher time frames, like the hourly time frame in this example. Now, does this only apply to higher time frames? No. This applies to lower time frames as well. We're going to get right into that in 1 second. So now that we've tapped into equilibrium, where does price probably want to go? Well, it probably wants to head back to the swing low, right? It probably wants to head back down to this low that we have formed right here. So are we going to look for sells? Yes. Are we going to look for sells off of the higher time frames? No. Let's drop down and let's see what the lower time frames are telling us. So I've just dropped down to the 5 minute time frame, and what can I see in this case, right? Well, I can see that right before market open, we had this big sell-off. So what are we probably gonna do? Do the big banks want to sell here? No, because it's a bad price. So what are they going to wait for? They're going to wait for price to pull back into equilibrium. So let's mark out where our equilibrium is. If we get our swing high right here and we mark it down to our swing low right here, what can we see happens? We can see price comes down, retraces into this discounted zone, and bang, we get a swift, lovely sell-off targeting this draw on liquidity right here. Did we only tap into equilibrium? No, we can also see that we rejected off of this 5 minute bearish fair value gap. Do you see how the lower time frames and the higher time frames are extremely correlated? The higher time frames are telling us the exact same thing. We want to go down. We've come into a discount. We're rejecting off a higher time frame gap. What are the lower time frames telling us? The exact same thing. We retraced into a bearish fair value gap. We retraced into a discount, and now we want to sell off targeting this low right here, right? Because that is our draw on liquidity. Do you see how it is playing out? And all I had to do was mark out swing high, swing low, pull back into the midpoint, reject, bang, straight down to the draw on liquidity. That is how I've caught this trade today. Let's break down exactly why I took it as well. Let's just drop down to the 1 minute time frame and I'll show you my exact confluences for taking this setup. So if we see on the 1 minute time frame, what else do we have? Well, we can see after tapping into equilibrium, we've got this big sell-off. And then what do? Well, we actually inverse this 1 minute bearish fair value gap. Sorry, this bullish fair value gap. I've marked it out right here. We can see it's a 1 minute bullish fair value gap. And we get this candlestick closure, which closes below it. So that right there is an inverse fair value gap. That tells me that structure is shifting. We are shifting from bullish to bearish. Now I can look for those sells. If I pair that with all of my other confluences, sells are definitely the play, right? Now, when I enter in this position right here, where do I want to set my stop loss? Well, I typically want to set my stop loss above a bearish fair value gap. As you can see, we have a 1 minute bearish fair value gap right here. So what did I do? I simply just set my stop loss right above that. This is going to act as a security guard. This is going to be a safety barrier, because what might price try and do? It might come up, retest this zone, and then sell off, meaning I am then protected from price hitting my stop loss. Anyways, what do I then look for? I then look to target this swing low, which is this draw on liquidity, and bang, swift, beautiful, clean sell off, very quick trade. And that is exactly how to use equilibrium to take trades like this. Hopefully this made full sense. Honestly, it does not get any easier than this, right? When it comes to equilibrium, you just want to mark out the high to the low or the low to the high. It depends on whether you're looking for buys or sells, but it's the exact same thing. You just want to wait for price to pull back into a discount. You want to drop down to the lower time frames, wait for your confirmation, take the trade, target liquidity, bang. Just like that, you've caught a banger of a trade. And all you did was use one of the easiest confluences in trading. Hopefully this video helped. Hopefully this video taught you a lot about how to use equilibrium, how it applies to both the higher time frames and the lower time frames, and how you can correlate it so that it just makes your trade A++. We don't take low probability setups around here. We only take the higher ones. And how do we do that? Well, we make sure that our time frames are correlated, the higher time frames to the lower time frames. And equilibrium has just been shown to do that. So guys, remember this confluence, practice this confluence. If you have any questions, drop it in the comment section below. I am happy to help you out. But yeah, I hope this video helped. Please like, subscribe, share the video, drop a comment if you need any help. I've got you. And thank you for watching. I will catch you in the next video. Peace.